Hello everyone, Charles here, and in this presentation I'm going to cover the next part of our harmonic patterns guide. Today we'll cover harmonic pattern basics and popular patterns. As with all of our presentations, we must start with a disclaimer. Feel free to pause the video and read through the entire disclaimer, but when trading any financial asset, there's a possibility you may sustain a partial or total loss of your investment funds. As a result, it is advised you should never invest with or trade upon money which you cannot afford to lose. Trading involves a real risk of loss, and past performance does not ensure future results. So let's get started. First, I'll do a quick recap on some of what we covered in the previous presentation. Founded by H.M. Gartley in the year 1932, the harmonic patterns as well as concepts of trading were later improved by Larry Pesavento using the concept of Fibonacci ratios. The main concept behind the harmonic patterns is the movement in time or price that adheres to the Fibonacci ratios and their market symmetry. The main reason for using Fibonacci ratios is to determine the major turning points, extensions, retracements, swing low and swing high points. The projections as well as the retracements derived after using such swing points provides traders with main pricing levels for stops and targets. Harmonic patterns offer trusted price entries, targets, and stop-related information. They can be easily combined with many other oscillators or indicators to take accurate trading decisions. Examples. Now that we know what harmonic patterns are, let's take a look at some of the examples. Most of the traders today use the Gartley chart pattern for trading. Other popular harmonic patterns that are traded and that we will cover in depth throughout this series include the bat, butterfly, crab, and cipher patterns. The Gartley pattern. This was created by H.M. Gartley. This pattern was introduced by him in the book Profits in the Stock Market. This pattern is also referred to as the Gartley 222. The chart features black lines that represent 4 price movements within the chart. They do not have to be black lines. You'll see all different variations of colors. Okay, that's just the way that it started. Same with any other color references in these presentations. That is just the common color that you will see. Okay, so blue lines, as well as the values in percentage, represent the retracement point between each and every level. The arrows in green represent the potential movement in price patterns. Okay, so here you're looking for 4 price movements. Like I said, they're not always going to be black lines. They could be any color depending on your indicator and the way your chart is set up. Okay, so here are the black lines that I'm referring to, and here. Okay, the X, A, B, C, and D are the pivot points. Okay, the X is the start of the pattern, and the D is the end of the pattern. Here are your Fibonacci ratios. The B is sometimes referred to as the eye of the pattern. Okay, the center. And these arrows, which may or may not show on your harmonic pattern indicator, EA, or whatever it is that you use, okay? But they just show price movement. So in this one, this is a bullish Gartley. This one is a bearish Gartley, okay? The projected outcome of the bullish Gartley is that price will rise. Okay, and the outcome of the bearish is that price will go short. Okay, The bat pattern. This pattern is a modified version of the Gartley chart pattern and was designed by Scott Carney. A look at the chart will reveal that it has lines which are symmetrical in shape. In fact, the pattern's most crucial ratio is the 88.6% Fibonacci retracement ratio. See that here. You see that the bat pattern draws similarity with the Gartley pattern, but with different retracement levels. However, both the patterns are known as internal patterns. Okay. Again, here are your lines creating the start of the pattern. Here are your pivot points, X, A, B, C, D, X, A, B, C, D. Okay, you can see it's creating an M and a W. Okay, and then the projected outcome for price. Or outcome direction, I'm not going to say, because we don't have take profit levels in there yet, but that I will cover very shortly. The butterfly pattern, yet another modified version of the Gartley pattern, is the butterfly pattern that features the same 4 price movements. You can see you have your M and you have your W. Okay. However, the levels of retracement are completely different. This is known as the extension pattern because the D leg stretches outside of the XA. Here's your XA, and here's your D. Okay. Thus, when you look at the bearish and bullish butterfly chart patterns, they indicate that AD price move should be stretching beyond the earlier price movement of XA. Here's XA. This is exactly why the butterfly pattern is referred to as the external chart formation. Okay, that simply means, okay, let's take a look here. AD, this is AD, should be stretching beyond XA. Okay. Oh, that is it. Just clicked on it. But we'll get into more depth. I'm going to break down each pattern for you in our upcoming presentations. As already mentioned, there are many types of harmonic patterns. We will cover these in more depth in upcoming presentations. I will do my best to keep things as simple as possible throughout each. Here's a list of some of the things we're going to be covering. Along with different harmonic pattern coverage, we will also go in depth on how to trade each. Okay? I want you to feel comfortable with these and be able to accurately identify these patterns. Know before you enter the correct entry, stop loss, and take profit range. That's it. In my next presentation, we'll begin to cover the mathematics behind the harmonic patterns and break everything down to its simplest form. If you liked this video, please feel free to like, share, subscribe, and comment in the comments below.